This is another very important video. I am making this video because I noticed that some of my YouTube subscribers still need some clarification about the base that you see on this diagram. So, as I have mentioned earlier, we need minimum 4 points in the base. We need minimum 10 candles in the base. So, the problem that is happening now is when one of my YouTube subscribers see that there are 5 points in the base, there is no point 0.6 complete yet. So they are taking point number 5 as the buy point. That is not correct. See, point 5 is a buy point only when point 0.6 is complete. Just a second. See, point 5 is a buy point only when point 0.6 has been completed. Similarly, point 3 is a buy point only when point 4 is completed. So if you look at a chart and there are only 5 points in the base or 7 points in the base, then 7 does not become the buy point. The latest proper buy point where the wave has been completed. See, this is one wave, this is second wave, this is the third wave, this is the fourth, and this is the fifth wave. Allow that wave to complete, allow that triangle to complete. Okay, only then take that point as a buy point. So I was surprised after giving so much explanation on the channel. Some of my subscribers were making this mistake. So don't do that. That's why I said this is an important video. We will go back to the example of Tata Investment. So if you see there are 6 points in this base, I will draw this point 1, point 2, point 3, point 4, point 5, point 6. So since there are 6 points in the base, point number 5 becomes our buy point. And by the way, don't forget the mother baby candle combination. Okay. So there are 6 points in the base, point 5 becomes our buy point. Now let's assume that this candle is not there, that baby candle is not there. Now tell me how many points in the base? 1, 2, 3, 4, and 5. 5 is always lower than point number 3. So there are 5 points in the base. So in this case, the yellow line should be at the high of this candle because point 3 is your proper buy point as of this date. As of the close of this candle, point number 3 becomes your buy point because point number 4 is available. Point 5 is not a buy point because point 6 is not available. Okay, remember this. This is the only reason why I made this short video. Apart from this, I wanted to explain one additional concept, okay, which I will do now. By the way, you know already this breakout shot up 20%. Let's come here, okay. Let me draw some bases for you to give you some. I will remove this yellow line, okay. So have a look at this base. So this is slightly below. How many points in the base? 1, 2, 3, 4, 5, 6, 7, 8. So point number 7 is our buy point. So nice consolidation on the right side of the base. So if I move it here, okay, let me draw another base. So if I 1, 2, 3, 4. So have a look at this. How many points in this base? 0.1, 0.2, 0.3, 0.4. So both of these bases qualify as per our criteria. In fact, I think both the points are in the green zone. So if I draw this, you see here the buy point is in the green zone, something like this. Okay. Let's keep it here. Let's keep it here. Let's keep it here. And this should be in the, so buy point and closing price. So this is very good buy point. And we will draw this also. Have a look at this. Now, have a look at this base and this base. By the way, both of them qualify as per our base point counting criteria, right? But you tell me, looking at this diagram, which one of the bases is a high probability trade setup? Which one of these two bases uh, are more, or I would say, which one of these two bases are less risky? That would be the right question, correct? This base is a less risky base than this base. Although both qualify, I might buy on both. I might buy both stocks, right? But this is a more high probability base than this one, and I will tell you the reason why. Okay. In both the cases, you see the buy point and the closing price are in the green zone. In both the cases, you will have blue, green, red moving averages. In both the cases, you will have minimum 4 points in the base. In both the cases, you will have minimum 10 candles in the case. In both the cases, you might probably have the mother baby candle combination as well. Okay. So both bases qualify our basic technical criteria. But for me, this is a safer base than this. I will tell you the reason why. Remember, I have been telling you repeatedly that the chart is an effect, it is not the cause. So, here what is happening is since you are buying closer to point number one, okay, the chance of overhead supply putting pressure on the stock is very low because you are buying in the green zone. However, here the problem is now people who bought here in this area, that supply will start coming here, and people who bought at this level, that the basic natural overhead supply, they also would want to sell here, right? So the supply is coming from people who bought here, who want to get rid of the stock because maybe the base could be 2 months long, they are already fed up of the stock, and people who bought here, they are getting nice profits from here to here, so they might want to come out of the stock, correct? So proper consolidation like this has not happened. That is the reason why here the chance of a breakout, the chance is always there, but you need enough volume to not only absorb this supply coming in, but also supply coming from buyers who bought the stock in this area. So you need to counter both the supply coming in. So you need high volume to push the stock up on this. But if you look at here, this is a proper natural consolidation. People who buy here, sell here. Again, people who buy here, sell here. Again, people who buy here, sell here. So there is natural, normal consolidation happening towards the right side. All of a sudden, these people who bought, all of a sudden, that supply might come here. And since it has not properly formed multiple points in the base, that is why the stock might squat here. Squat means it goes up, people who bought here, people who bought here, they sell, and the stock closes below the yellow line. That's the problem with this. So remember, I had made one video on how to identify the quality of the base. In that point, I had mentioned that more the number of points in the base, the better, right? The smaller the height of the base, the better. The longer the length of the base, provided it is within 52 weeks, the better. Okay. And the more it is in the green zone, the better it is. If both the closing price and the yellow line are in the green zone, the better it is. Okay. Green zone is a safer place to buy than the blue zone and the red zone. Anyways, red zone, we don't even think about buying. But since both of them fit our eligibility criteria, I am just telling you which one is less risky. I am not saying don't buy. I am saying when you buy, you must understand which is a risky base, which is a less risky base, right? When you have that awareness of risk, only then your mind can start thinking about position size. How do you control risk? Two ways: control your position size, keep a tight stop loss. Those are the only two ways to control risk. But what if your mind is not able to perceive risk? What if your mind is looking at this base and saying, okay, this meets our criteria, this meets our criteria, let's give same weightage to both the bases? No, no, that is not the case. This base is a far better base than this base. Okay. So you could buy at both the buy points. There is no problem in buying. The question is how much risk are you willing to take? Okay. How are you going to manage the risk? I might buy this stock with an 8% stop loss, but I might buy this stock with a stop loss at point number 4. You understand how I controlled risk now with that just one statement? I might buy the first one with a 8% stop loss because it has a nice consolidation. It doesn't need a tighter stop loss. But on the right side, I might buy at the yellow line with stop loss at point number 4 because I know the consolidation here is not yet properly there. That is why when I drew the diagram first initially, this diagram is available in my video course also. That is why I have drawn a diagram like this. This is the ideal thing we want to see. If you look at this stock, see both the buy point and the closing price were inside the blue zone. Okay. It is still a very risky pattern. The buy point and closing price were not in the green zone. It is still a risky uh, trade setup. Okay. Look for trade setups where the buy point and the closing price are preferably in the green zone. So basically, as a professional trader, to use this strategy, you need to understand two concepts: the reduction in the retail supply and the supply pressure that is coming from overhead supply. Okay. Overhead supply and retail supply. If you understand these two concepts, then you will understand what is happening behind the curtain, right? It is not just about counting points and counting candles and blue, green, red. Anybody can do that. I already told you blue, green, red, 10 candles, 4 points. Anybody can do that. But visually, when you look at the base, you should get a sense of how much risk you are taking. Okay. Your analysis, your visual analysis is far more important than that blue, green, red, 10 candles, 4 points. Blue, green, red, 10 candle, 4 points is just a qualifying criteria. It keeps you in safer stocks. Okay. So that you don't make silly mistakes in the market. Another thing I wanted to explain is, let's say something like this. Some people look at this. Some people look at this and they want to buy at point 0.3. Now that is again, I mean, there is no consolidation happened. We need minimum 4 points in the base. People see that Market Smith wants this as Market Smith marks this as the pivot point, and the stock is already here without even doing a proper consolidation. So, in such cases, generally what happens is if you try to buy at point 0.3 without waiting for point 0.4, in such cases, generally what happens is the stock breaks this pivot and then it goes here and then it crashes down. Sorry. So, it goes from here to here, then it starts to crash down. Something like this starts to happen in the stock. Okay. Why does this happen? Why does the stock go up momentarily like 5-10% and then collapses? Because consolidation did not happen. Okay. So this, let's say this is base number 2. So this point becomes the point number 1 of base 2A, and this point becomes point 1 of base number 2B. Okay. So now a new base starts from here. You see, it starts like this. You understand what I'm saying? So if base number 2A is does not have proper consolidation like this, then it will form base number 2B. It is most likely to form base number 2B. We are still in base number 2, but it's the second version of the same base. Okay, that's the problem. So when you buy here, your chances of stop loss getting hit is high. But when you buy here, your chances of stop loss getting hit is low. Because from here, the stock might start to move up. And then after it goes 20-25%, it might start another consolidation. And the low of that base will always be higher than the 0.1 level of this base. Let me repeat that. The low of the next base will always be higher, or in most likely it will be higher than point number 1 of this base. That's called proper next level base formation. Okay. So I hope you understood all these diagrams. It will help you understand this strategy better. Thank you so much.